everyone. Thank you for joining us today for Selling a Small Business and Succession Planning. It is 10 a.m. on the dot, and I will be admitting everybody in as they come in. Please let us know your name, your business, and where you're located in the chat. My name is Lisa Gilbert. I am the training coordinator for the Nevada Sbdc. I'm located down here in Las Vegas, but I provide training all statewide and hopefully in person later this year. The Nevada Sbdc is your first call to start or grow your business. We promote economic development across the state by providing no-cost, confidential business advising and training. You can access our services by visiting our website at www.nevadasbdc.org. So the Nevada Sbdc is proudly supported by the U.S. Small Business Administration. Again, we're just getting set up, so we'll get started in just a moment or two. If you have any questions during the presentation, feel free to put those in the chat or the Q&A, and our panel of experts will get to you. Stephen, Tom, and Gina from US Bank are here with a wealth of knowledge and tons of experience to help small businesses and personal banking, all good stuff. So again, this is your presentation. So Stephen, it's all yours.
Well, Lisa, thank you so much. First of all, I do want to just say thank you to you as well as to the entire Sbdc, because of course we really appreciate the opportunity to get on here and talk to some business owners here. So thank you for that. We really appreciate that partnership. So today we are going to really dive into selling a small business and succession planning for your business. We want this to be informative, but we also want it to be interactive. So, you know, we've got an agenda, but at the end of the day, our goal is to get as much information as possible to you, the business owners. So if you have questions, you have concerns, shoot them up in the chat, raise your hand. Gina will help us out to make sure that we're managing all that. We'll take a look at stuff, and we're happy to stop presentations or answer questions through the way, because again, our goal is to make sure you get the information that you're looking for, right? So with the agenda, again, we'll start out talking about selling small businesses. We're going to go into some of the succession planning, and we're going to talk about the different areas and aspects you have to consider when looking at selling a business, or when looking at, you know, creating retirement planning for your business as well. Some of the ground rules, again, ask. If you have a question, there is no silly question. Raise your hand, put it in the chat. We're happy to address everything along the way. Also, we realize that we may be experts in what we do and what we have done for the last 20 years. For me, I've spent 20 years in banking, right? But we also understand that you guys are experts in what you do as well. So if you have information about something we're covering, feel free to interject it. It's by learning from each other is how we're really going to get the best out of everything here. And so we want to do some quick introductions. Obviously, you guys are putting out your introductions in the chat, and we really appreciate that. Love seeing all the different businesses that are out here. Me personally, I am a business banking development consultant with US Bank. I've lived in Las Vegas for the last 17 years and worked in banking for about 20 years now. I've worked in retail and leadership, in business banking, in private banking, and wealth management. So I really have a holistic view when it comes to managing a business and how it plays into those other parts of your life, especially given my investment days. I brought a couple experts with me as well. So first of all, I would like to turn it over to Miss Gina just to say hi. She is actually works here in Las Vegas as a project manager. So Gina, tell us a little bit about yourself and how you're supporting us today.
Hi, well, as Stephen said, my name is Gina Contreras, and I am the project analyst for the Las Vegas market. And I do a lot of presentations for financial literacy in the Las Vegas market with Stephen Ness. And here's another one that we're doing, and I'm happy to be here.
Awesome. Thank you so much, Gina. We really appreciate it. You definitely help keep us organized. You know, and I know that I don't know everything on myself, so I went out and I tried to find an expert on what we're talking about, and that led me to a senior vice president, I believe, here with US Bank, and Mr. Tom Smith. So Tom, why don't you introduce yourself, sir?
Yeah, thanks everybody. Great to be here. So I'm part of a small group within US Bank. It's called Business Owners Advisory Services. We started about 4 or 5 years ago, but really refined the model and rolled it out 2 years ago. And our role is to work with family and founder-owned businesses and help them plan for and execute business transitions, ownership transitions, and integrate those transitions with their wealth management teams as well. My background before I joined the bank 2 years ago was mostly corporate development, both in the US and overseas for a number of different in a number of different industries: energy, industrial services, technology and financial services, human capital type businesses. In my career included a stint in Hong Kong for about 7 years trying to develop business for waste management, the garbage guys overseas. So I bought companies, sold companies, advised companies, and we're gonna happy to answer any questions you have today on any of this. Thanks.
Awesome, Tom. I really appreciate that. And as I said, I have a feeling we're going to be leveraging you for tons of questions today. And I really appreciate your experience and your willingness to help out. So thanks so much for that.
Great. Thank you.
So let's talk about our objectives, right? Objectives are really simple. Our goal today is we really want to help convey information to you guys to help you understand the changes of ownership of a business through the selling or closing or handing it to a successor, right? So we just want to help you understand there's different ways of succession planning, and we want to advise of those different ways and help to talk about some of the ways to determine which way is going to be best for you, right? And as part of that, we want to help you to understand establishing an exit strategy for retirement, including a succession plan, transfer of ownership. We'll touch briefly on taxes. Obviously, quick disclosure, neither Tom or I are certified CPAs or tax advisors. So we'll give you some of the stuff we know, but of course, there are times that certain questions come up where we may say, hey, you know what, we need to get an expert for that, because we always recommend that. The one thing you'll hear me say over and over again is surround yourself with experts. And that's why I brought Tom on here, because he is our expert in this area, right? So let's think about it. What do you want to know? Right? So there's so many things that we could try and figure out of what we want to learn. But what I would love to do is I would love to open this up. So you can either raise your hand, you can put it out there in the chat, but I'd love to hear from a couple of you of what do you want to learn about selling a small business, or what is your expectation that you would like to take away from the class today? And then Gina, if you could help me out with that, just because I cannot see the chat. So do we have anybody that would like to share what do they want to learn today, or what are they trying to get out of this training today?
It looks like from Julie Brander, we have business valuation.
Business valuation, right? So that's an important one. I don't know about the rest of you guys, but I watch Shark Tank regularly, and I love seeing them arguing about what's a business worth, how's it that? I know, Tom, we're going to be relying on you heavily for that to talk about different ways we can value businesses today. Would that be accurate?
Yeah, I can take that one.
That's awesome, awesome. What other things do we want to learn about today?
All right. The next thing we have is what it's like to do the physical transfer, about business licenses being in your name and all those logistics.
Okay, so that sounds like that's really, hey, what is the ins and outs? I'm selling, here's the contract, what's the step? How do we go from, company A is now company B, right? That makes a lot of sense. We can easily cover that for you folks today.
Yes. And then we have first steps in listing a business for sale.
Awesome, awesome.
Steps. Also, I guess, how much of a nightmare is it to do a transfer? So being gone once you have completed the sale, right? They just want to make sure that once they do it, is it really done?
Yeah,
when
that's a great one. Yeah, and we'll talk about that. I know Tom can share some of the stuff we've seen, right? But there's a lot about selling a business that is not a simple, quick transaction. There's these processes and periods that you usually go through. So that's a great question on there.
The next one is expectations on selling the business, the time frame, valuation, and how to prepare in advance.
All right, awesome,
Great
awesome.
question.
Well, I think, yeah, and I think this is the perfect call to do that, right?
Presentation, yeah.
Yeah, in the nutshell, that's going to be our presentation there, right? So let's look at some of the reasons why businesses sell, right? So obviously here, there's some of the basic ones, right? You get a good job offer, you have a promising offer of someone that wants to sell your business. But Tom, let me ask you a question. What are some of the main reasons you engage with business owners who are looking to sell?
Well, I think we've separated here into sort of business and professional reasons versus personal. Clearly, a retirement or change in life is a personal reason that's very common. And so, sometimes as you're responding to an inbound offer that's very attractive and you weren't thinking about selling, but look at the cash flow the business, say, geez, I can make X on a sale. I think I'll pursue the sale. Sometimes you realize that, you know, you may not sell 100% of the business, but you sell maybe 60 or 70% because you realize the business can grow faster on a bigger platform. Somebody's got more resources, more capital, better distribution, some management expertise that you don't have. It's complementary to your products possibly. And so you say, geez, I'll sell some ownership up front, but I'll hold on to 30, 40% and sell it in 5 years, and I'll make more on that 30% than I did on the 70% because of the value of the combination of the businesses.
Absolutely. Those are some great areas in there. And then on this last one, I think this is really relevant in today's world, right? When we talk about the market or industry changes, right? If you look in the late 90s, it would have been a great deal to buy Canon, right? Or Kodak or any camera company, right? They were some of the hottest growing companies, things like that. Well, the cell phone came about, and within 2007, those industries had been completely destroyed, right? And I mentioned that because COVID's happening, right? And we're seeing a change to the convention space. We're seeing changes to gatherings, right? So sometimes that pivot, as Tom just mentioned, now turns into a bigger sale, you know, or maybe you're really taking a position in the backseat of your company because you identify someone that may be able to help it fuel and grow, right? But we also realize that business and professional reasons aren't the only reasons. As Tom totally alluded to, there are a lot of personal reasons, right? So you could just be burned out, just be ready to retire. You know, maybe it's just family needs. Different types of growth in your personal life can really change the way that your business operates. You know, I've worked with a lot of business owners, and one of the things that I think Tom just alluded to that they don't think about so often is a lot of people think it's kind of all or none. Like, as I'm getting burned out or I'm running down, I'm ready to just get out and I want to sell the business and walk away. But there are other options, right? There are ways to maintain involvement or keep it, you know, try and keep your business moving the way you want, but still bringing in other partners, right? So I mentioned that because when you get burned out, sometimes people just think it's an all or none, and it's not always that case. It's important that we remember there's other things that are contributing to that, and we want to look at that holistic picture. So as we mentioned, you all should have had a participation guide. So we're going to open this up to our first question. So I'm going to give you about a minute or two real quick if you want to start. Just think this around, kick it around your head. If you want to write down the ideas, great. If you want to shoot them in the chat, that's awesome as well. But what we really want to know is, what do you feel is the main reason for you selling your business? All right.
So while those are coming in, I'd add one to it as well, is often the business is the biggest single asset for the business owner, and they want to diversify their financial risk. And that gets back to, you know, selling part of the business rather than having, you know, 90% of your net worth tied into a single activity, even though it's a business and you can control the operation.
Awesome. Okay. So if you could just, thank you, Gina, for taking that over. I appreciate it. If you could pop it into the full screen view, and then let's jump to slide number 10, actually. So 9, we've talked about some of the reasons, right? Burnout obviously is up there as one of them, and I totally understand that, right? It's very difficult being a business owner, very time consuming, a lot of stuff you're doing there, right? So one of the things they said is, what are the steps to selling a business, right? So we talked about, why do I want to sell? You know, we've put some information out there. So the next thing we need to know is, like, the first thing I think we need to determine is your business sellable, right? So we talk about why it's sold, right? Or you've got an offer, things like that. But Tom, when you think about, is my business sellable? What's one of the first things that comes to your mind when you talk to business owners?
Well, I think the first thing is, you should always look at your business as a buyer would look at it. You know, we all love our babies and our children, but, you know, how will a dispassionate buyer look at your business? And the essence of the transaction really is, with very few exceptions around intellectual property or something of that nature, is, you know, what's the expected cash flow generated by that business? Is it growing? Is it predictable? And what are the risks to maintaining that level of cash flow? So the buyer will look at that and try to make an assessment. I'm going to give you a pile of cash today for this business, and over the next period of years, I'm going to get that cash back. And what kind of return do I need on that investment, given the risks associated with the transaction? In essence, that's what every sale goes through. Then there's more detail underneath that.
Absolutely, right? So we're looking at a combination of things here. Now, I know there's different ways we could look at this, right? When we look at evaluating a business, particularly by its profits or revenues, do you think there's a reason we would use one way versus the other, or could you maybe help us understand that?
Yeah. So, often you'll see businesses value it as a revenue multiple, possibly. Many times it's because there's not good information available, but basically the metric that we see the most is called an Ebitda multiple, which is earnings before interest, taxes, and depreciation. And it's really just a measure of the operating cash flow from the business. And so if I, pay 4 times the operating cash flow and the business holds flat for the next 4 years, I'll get all my cash back. I mean, that's sort of the way to think about it. My payback is 4 years, and my return will be 25% per year. So that's how investors, buyers think about making the investment decision. Some of the other things we have here are obviously important to determine how predictable and repeatable that cash flow is, or is it growing? So if you're in a growing industry, a fast growing industry, and you're maintaining market share, you're growing pretty fast. You have high quality property, for instance, a location, that's a sort of an intangible asset. I don't think quality of inventory is much as a factor. What happens there is you sell the business, it has to come with so much inventory. And if you have poor inventory, it'll detract from the value of the business. So you value the business, and then you say, are there any issues? So I had a sale I worked on at the end of last year. The business was worth $7 million. We agreed on that, and then we started heading down to detailed diligence. And there was a fair amount of inventory that was more than 2 years old. So it was deducted from the purchase price. It was $250,000 deduct. So the seller thought he's going to get $7 million. They got 6.7 million for the business because of the aged inventory.
Yeah, no, that's great. And you mentioned EBITDA on there. And I know for anybody who's done some research in the business selling, EBITDA is a very important factor there. One of the questions we have is, you hear a lot about a multiple, like this industry is selling for X of EBITDA. Do you have an idea of any good resources, or if I'm a business owner, how do I figure out what the multiple would be for my industry?
Well, that's a good question. There's not, even for us, where we have access to a lot of data, it's not always available for the smaller businesses. So the way I tell owners to think about it is, for a smaller, more illiquid type investment, investors like private equity type investors are going to look to get a 20 to 30% return on their investment pre-tax. So you kind of work backwards and say, if I'm generating $1 million of cash flow and somebody, needs to get a 20% return on that, how much can they pay for my business, right? So they can say, okay, I can pay $5 million for your business because I'm going to get $1 million a year return, 20% return. So that's more important than the multiple. The multiple is used as a proxy to how do you get to that return equation, because you don't have that information. But it's really, what kind of return does a buyer want to get? How much cash am I generating? And then so how much can they pay if they're trying to get to that return? Does that make sense?
That makes absolute sense. Now, good question here that's jumped onto that. Do we look at it differently for a service business versus a product-based business?
Yeah, I think not necessarily between a service and a product based. The thing that makes service business more unique, though, it's the heavy human capital component. So if you're in a service-based business and it's a personal service, and you have 4 or 5 people who are, so I'll give you an example. I worked for Piper Sandler for a number of years. It was an investment bank. We did M&A advisory and capital raising, but it was all about the people. We didn't have any real assets. So if we were buying a business, we might say the business is worth $20 million, but we're not going to pay the equity holders $20 million. We're going to pay them 10 and take the other 10 million and spread it across the people who are providing the service and generating the revenue.
Okay, that makes a lot of sense, right? And then there was another follow-up question. It looks like to EBITDA. It said, when in determining SDE versus EBITDA, is it difficult to separate in an S corp?
I'm not sure. Did you say that again?
Well, it said determining, and it's an abbreviation SDE, which I apologize, I am not familiar with. I'm not sure if you
I
were.
am not familiar with that either.
Okay, so Jeff, if you could, I apologize, but if you could just chat out what SDE stands for, that way we can kind of clarify that one on there as well.
I see.
Oh, there we go. Seller's discretionary earnings. So if we're determining seller's discretionary earnings versus EBITDA, is it difficult to separate in an S
Again,
corp?
I'm not familiar with that term, but you would break out to, in an S corp, the main thing we're trying to do, and you see this in an LLC also, and this might be answering the question, is, whether an owner takes it out as compensation or distribution at the end of the year, it's all fungible. So we look at it and say, if the owner sold the business and paid themselves a market rate for what they were doing, what would the EBITDA be on that business? And that's what the buyer is going to be paying. Because it's discretionary to the business owner. Do I pay myself a salary, or do I not pay myself anything and take it all out in December in a distribution? So you have to really get to what's the market rate for the owners of the business to the extent they're employees as well, and then adjust the cash flow of the business for that. So you can really get to what is the business generating as a standalone business. Does that answer your question? I'm not Steve, who asked the question.
Yeah, well, yeah, I believe that does. It addresses it. By all means, if there's more follow-up, definitely shoot them out. They did ask if you could just kindly repeat what you just said.
Sure. So seller's discretionary, I think I'm interpreting that as one of the challenges with an S corp or an LLC is whether the owner takes out a monthly salary or pays themselves a lump sum at the end of the year as a distribution of profits. It's really fungible. They're both the same thing. So some cases the owner says, I'm going to pay myself. I have a client, 3 owners, and they pay themselves a total of $1.25 million a year. Now, if the business gets sold, those 3 positions are probably worth around $600,000 a year combined. So they're just taking out in their salary in advance on distribution at the end of the year. If we sold the business, we would say their real compensation is $600,000, and we would add the other 650,000 back to the EBITDA of the business as the new owner would look at it.
Got you. No, I appreciate that. And when we talk about valuating businesses, one of the things we run into is there's assets as well, right? And so we've talked a lot about the revenue streams, things like that. Have you run into any situations where you have unique assets that are difficult, or what's your thought process about that when it's not something simple?
Well, in most cases, when a business is sold, it's sold with the assets that are required to run the business. So it has to have a certain amount of inventory. You're going to have a certain level of receivables offset by payables. You might need to keep a minimum amount of cash. And of course, if you're manufacturing something like that, or you have to have equipment in the business. So you say, I'm buying the business and here's the value of the business, but it's all generated by these core assets. So you have to, and you agree in the purchase agreement, what is the right level of inventory and receivables that come with the business at close. So if you need $1 million of inventory, and you get to closing the sale and you have $2 million of inventory, you get an extra $1 million on that sale because you have excess inventory. If you only had $500,000, business needs $1 million, you deduct that from the purchase price. So the assets themselves are valued only to the extent as being required to run the business. And like the example I used, the business needed $1.5 million of inventory, 200,000 of it was aged. And so they deducted that from the purchase price. Now, the exception is real estate is usually valued separately from the business. And it can get quite complicated, but it usually has an inherent value on its own. And an owner may, many times they own the inventory in a separate entity from the business and they lease it to the business. So you can adjust for that and say, okay, the owner continues to lease the real estate. Is it leased at market value? Then it's okay. They could sell the real estate, but you do a separate valuation of the real estate compared to the business. And the other exception is if you have some unique intellectual property, and this happens in the biotech world. I have this great cure for cancer or medical equipment, piece of medical equipment, but it doesn't have any revenue yet, you value that based on the market potential, the potential revenue for, it's addressing $1 billion market. It's going to capture, 20% of the market share for that particular cure. And so we'll value it based on the market potential.
Awesome. Awesome. No, I really appreciate that. I know for me personally in dealing with businesses, so often we've seen, hey, my business is worth X, but then I have this much inventory in this, and they think that that's an instant add on there. And I really love how you help clarify that you have to understand how much is needed for normal operations and kind of already in that intrinsic value, and then adds on beyond that. So great information there. I really appreciate that. So one of the things someone said they wanted to talk about is what does this look like? Okay, I've decided I'm gonna sell, I'm getting ready for it. So now it's time for me to prepare for my sale, right? So what do I do? And I know the first thing we say is, hey, you need to resolve any standing problems out there, right? And one of the questions that came up, it says, how do you deal with partners and partnership disputes? So obviously that's a great question that talks about resolving problems. So let's say I'm going to sell my business, but there's a dispute. So obviously you need legal counsel, right? But what are any other tidbits or thoughts, obviously, about handling those disputes prior to a sale?
Those are very facts and circumstances specific. When I get involved, whether I'm their primary advisor on it, but because I work with business owners and family-owned businesses, there are conflicts that will get asked about. In case there was a company out in California actually that I worked on a year ago, and the owner that wanted to sell, he owned 35% of the business, and the other 3 owners owned the 65%, and they were ready to get him out because he was not part of the management team, and he really had no leverage on how much they would pay for his 35% share, so they offered him a very low amount. There was a lot of conflict around their partnership. They'd been together for a while, and so they had a lot of bad feelings. As an advisor to the seller of that 35% interest, one of the things in this sort of a long way to tell you, look at your foundation documents, your bylaws, your partnership agreements, and so forth, because they're usually the path to dispute resolution. And in this case, the seller of the 35% share really had no leverage to get them to increase. We told them you're well below market. And so I looked at the bylaws and the various agreements associated with running the partnerships and determined that they needed his approval for a very major decision impacting the other 35% shareholder. That could have had a financial impact on him if they didn't get our approval for that. It was forgiveness of a loan that the company had made to this owner. And so we made it clear that we were not going to approve the extension of the loan. He had to repay it, which means he had to come up with a lot of money, or have it forgiven, which he had a big tax liability. And the owners then got together and said, well, that's not good. We don't want that to happen. We're going to pay him a fair price. We got him an extra 35% on his sale of his 35% ownership in the company. So he went from 5 million to 7.2 million.
Awesome. Awesome. Yeah. I like how you mentioned that, reference your founding documents. I know when I'm starting and speaking with new businesses, it's something I cover with them is, hey, what are you going to do when things go wrong? So it's always important to put it on there. There was another question that actually came through from Valuation that I hope you could touch on briefly is, how do you go about placing a value on your branding or your trademarks?
Yeah, that's a really good question. And you don't necessarily, yourself create that discrete value. But when a business is sold, the accountants will come back for tax purposes usually and say, you're paying $10 million for this business. How are we going to allocate it to assets within the business? Because if it's an intangible asset, you can depreciate it quicker than you can goodwill. And so a brand, a name recognition, that type of thing is considered an intangible asset, and it will get assigned some market value, and accounting firms will treat that with some precision, but there's no real level of precision. They kind of go on what's customary for each industry.
Okay, that makes a lot of sense. And I know you said it earlier, and we're going to touch on it later. But when we get an expert for selling a business, that's not just any attorney, right?
Well, no. In fact, if you're selling a business, you should really surround yourself with the appropriate team. If it's a sale of the right size, you probably should have an advisor like we do, an M&A type advisor, and help you get your business organized, how to run a process, how to prepare for diligence and get organized for diligence. I think you want to have not just a lawyer, because a lot of these businesses have their sort of family lawyer or business lawyer. You need somebody who's transactional, who's done M&A transactions. The third advisor I'd say is required is a good tax advisor. And your transactional guy might be your tax advisor as well. And then I think that to the extent it's intersecting with your wealth management, you should have your wealth planner and wealth manager aware of the transaction, because you really might want to do some things, and you could probably speak to this, Stephen. You might want to do some things with your ownership or your trust or whatever, transitioning in front of a sale where it's more tax advantageous to contribute ownership to a trust for one of your children at a lower value before you go through a sale price, so you don't use as much as your lifetime exemption, gift tax exemption. Because if you do it after the sale, you don't get as much. You get dinged more for that. And there's some things you do on a sale where you might take a seller note. You fund part of the sale as a seller, and you might put those into a type of trust the interest rate will fund the trust, sort of a grat. But again, I'm outside of my field of expertise.
Yeah, no, I mean, you hit on a couple highlights that I would have mentioned there as well. So often people look at sell their business, they're like, whoa, man, this is going to be a huge tax liability, right? And so, yeah, I'm excited. I'm going to get 10 million for my business, but I'm losing 30-40% out the front door, right? That's where it's so crucial to involve wealth planners, things like that. Tom mentioned it's called a grantor retained annuity trust, right? But there are ways you can give away your business at its current valuation to family members, other individuals, things like that. And then that can grow exponentially, right, when the sale happens, and then they could still have that smaller original tax basis. The other point that you touched on, which we see a lot, is like some type of owner carryback, right? Where the owner does some type of financing. We see that a lot, particularly in situations like we're in now, right? During COVID, we've seen businesses struggling regularly. So you may see a business that's kind of ready to exit. 6 months ago would have been easy and great, things like that. But now, however long we've been locked up now, I forget. But nowadays we look at it and we're like, wait a second here, yeah, it was worth that then, but nowadays it's not looking so great, and an owner's just ready to get out. So they'll say, hey, I'm willing to carry X, in order to make this happen, right?
And that type of structure can also be used to bridge valuation differences. So you say, like, I want to get, 5 million on day one, and the buyer says, I think you're only worth, 4, it's only worth 3.5. So you go, okay, I'll take it over a 10-year note. Now the buyer is paying out of operating cash flow, so it's a little less onerous, and they might be willing to stretch on overall headline valuation. So there's always headline valuation, and then structure and consideration. It might be cash up front is king, seller note, you're taking equity-like risk, but getting, senior debt type returns, but that might be okay. Or you can do it on an earnout, which also will bridge valuation gaps.
Yeah, absolutely. So other things that we look at when we talk about resolving problems, particular for the environment we're in right now, is the PPP loan, right? So if you're a business owner and you got a PPP loan, that's something we're seeing that could potentially come up. You just have to deal with it, right?
No, there's a solution to that now.
Yep.
It was difficult for the first few months, but the solution today, many of the smaller ones are getting forgiven already, but what the SBA has come up with says that the owners have to take that loan amount and put it in an escrow that they are funding outside of the business itself. And then that decision to forgive or not forgive the loan can happen at any time. If it isn't forgiven and the loan's still sitting inside the business and the business has a change of control, that loan has to be repaid. That's a term, but the solution is the owners put it in escrow, personal escrow, outside of the sale of the business. And then if it's forgiven, not forgiven, they're the beneficiary, or they cover the cost.
Awesome, awesome, right? So let's say a business owner has done these things, right? They've looked at any problems that are outstanding. They've got their financials in order, working with their CPA. They've built up their business plan. They're securing the relationships we've discussed, right? A specialist in law, accounting, things of that sort. So then they're ready to list a business for sale, right? So one of the things they said is like, hey, if I'm ready and I want to list my business for sale, how do I do that? Or so what would you recommend as a couple, maybe 2 or 3 different avenues you would research about listing your business?
Yeah, I would say a lot of businesses never get listed per se. Usually, I run into a lot of situations where the owner says, there's 2 or 3 that are the likely buyer for us. If you list, you can go out to something called a business broker, and they'll post it to 1,000 different people in their database and see where it sticks. And that's a good way to get execution certainty. But for most businesses, you kind of know, hey, there's 1 or 2 or 5. Somebody's called me on a regular basis and wanted to buy it. So it's you could sell it to an employee or maybe the other partner. You could sell it to a family member. Those are the usual transitions we see for the smaller businesses.
Absolutely, right. And when I look at our potential buyers, when I think of employees, there are companies out there that are employee owned, and many people may or may not be aware of them. But I know there's particular businesses, when you have like a really strong vision or value behind your business, that there are types of businesses that I think lend better to an employee sellout, right? So I'm in Vegas, right? So when I think of businesses like that, one of them that comes to mind for me is Zappos, right? Particularly with the owner passing away last year, right? That's a type of company that has such a strong mission behind it that I could vision a business that's not doing as well that would actually sell better to their employees in that type of situation versus an outside investor, right? Or secondly, when I think of this list of prospective buyers, man, think of it this way. In the last 10 years of the tech industry, there have been so many businesses that are set up and say, it's my goal to be acquired by Google or Amazon or Apple or Facebook, right? Look to your competitors, right? If you're burned out and you've been battling with someone across town, man, that's a great time for me. I think raise that white flag or at least bring the conversations out, right? So often that your competitor could gain well by purchasing you out.
Then I would say with competitors, it's you got to be careful because they are competing with you and they could damage your business. So I think you want to early on, if how you enter into that conversation, it's got to be sort of, well, at some point I'm going to sell. I'm thinking about alternatives. I'm a few years out, and see if they come back and say, hey, when you're ready, would you call me first? Theoretically, the competitors should be able to pay the most because they will benefit from cost synergies. To the extent you're the management team and you're going to get replaced by their management, or you're bringing customers to their fixed cost base, they will generate the higher margin off of your revenue than you do, and they can pay you more as a result.
Absolutely. So we've got a question that came out here. So let's say you're a company that doesn't need to list for sale because someone came to you. So is it still helpful to have a broker involved, or is an M&A lawyer sufficient? What's your thoughts on that?
You might be okay with just an M&A lawyer, depending on what kind of experience they have, if they've actually, where they've done, when they've gotten involved in transactions. I don't know that you would call it a broker, but an M&A advisor, where we get involved and we've had good success with clients, is a single buyer, but you make it clear to the single buyer that there are other buyers that have been interested, but we'll allow you to preempt the process, and as a result, get nudge up the price a little bit. I think if you're going to go with a single buyer, it's really important that you are absolutely clear on what your goals and objectives are, because once you enter into that sale process, you lose all your leverage. And I can't tell you, as a buyer of businesses, we're disciplined right up to the time we sign the definitive agreement, which locks in the transaction. We're very disciplined. If we learn more about the business, we may have to lower the price or may back away altogether. The seller, once they're deep into the process, they never back away, because now they're sort of thinking, I'm getting the check, I'm going to sell the business, I'm going to retire, or their employees hear about it. And if it doesn't happen, like, oh, what did they find out about our business? And so it's very disruptive. So you'd be very clear if the buyer comes back and says, you know, I was going to pay you 10 million, now I'm only going to pay you 8. Will you walk away? It's the only leverage you have, is that you would walk away. Once they sense you will not walk away, you're at risk of onerous terms or reduced value.
Awesome. We did have a question pop up too. What about for our small mom and pops? You know, when we think of that backbone of our society, that, you know, mom and pop shop, I think of some of my restaurant owners that are husband, wife, and things of that sort, you know, so we're talking typically $500,000 revenues, or, you know, smaller deals. What do you recommend to them if they're looking to sell? What's a good avenue for them, because they may not fit in some of the bigger boxes, right?
Yeah, it's difficult. You know, that's a very sort of narrow into the market. I think you could sell to some wealthy individuals like to own restaurants. I think in any case, particularly in the mom and pop cases, the idea that you're going to sell and retire probably is not the right way to look at it. You should look at it as, I'm going to sell, I'm going to continue to manage it for 3 or 4 years, and then I'm going to retire. Because the type of buyers who would come in for that business probably don't have the bench strength to replace you. And it's a huge risk to say you're the key person in that business. You do 3 or 4 jobs at once. You're the face of the business, and then suddenly you're gone. That's a huge risk to a buyer. So they'd want to know, am I going to have an orderly transition and continuity for a period of time, 1, 2, 3 years? You know, at the end of the day, you can always go out to a business broker. They charge a lot, but they'll go out to the biggest pool of buyers, and you'll see who's interested in this kind of business.
Yeah, no, that's a great point, right? Because when we think about, hey, someone's going to buy my business, I know it's very simple as a business owner to say, hey, are they qualified? Meaning, do they have enough capital, enough cash, right? That's the first thing that runs in most minds. But I know when we negotiate the deal, we also want to think beyond that, right? You know, do they have the expertise to manage this business and run it well? And if they don't, who are they bringing in order to do that? Now, Tom, you mentioned something that's really important, right? And you talked about, hey, typically it's not just going to be a sale and then I leave, right? Generally, there's going to be some type of assistance, non-competes. So why don't you talk to that a little bit, Tom? You mentioned, hey, you know what? It's not you're going to do this and walk away, right? Most sales, you typically have the manager doing something with the organization, right?
Yeah, I would say the exception to that is that, you know, what we call a strategic consolidator, selling to a competitor. If they have the, you know, depth and breadth of management teams where they can come in and you leave, they can replace you, then you're not tied down necessarily as much. But I agree with you. Absolutely, you got to make sure your buyer's got the financial capability to, you know, you don't want them to sign and expect to get that $2 million check at close, and he comes and says, oh, sorry. So if you're really not sure, ask for a financing contingency on it, you know, that they get some penalty if they don't come up with the financing and close the transaction. Non-competes, they're very typical. Again, it depends on the type of business, and they're very specific. So I would say my advice there is, you know, if you're going to really retire and just walk away, you really don't care how long you get locked out. But I would say keep it as short as possible, 1 to 2 years, for sure. And be aware of what state you're in. I don't know Nevada's laws, but having worked in a national business, it's almost impossible to enforce non-competes in California. They just, you know, maybe if it's related to a sale of business, you could, you know, the buyer can get you to sign up for a year, but it's really, really difficult. So if you're a buyer or a seller, you should be aware of the state by state legal requirements for the non-competes. And a non-compete has value too. So if you're saying I'll sign the non-compete, but I got to hit my purchase price, you don't take a reduced purchase price and a non-compete both. So it's all a lever to be played there.
Yeah, and that's a good point, right? We cover a lot of different things about business sales, but I mean, I'm sure you could attest to this, Tom. There's no two business sales that look the same, right? Even if you're selling two restaurants in a similar city, in a similar industry, they still look different, right? And so our idea is we want to get all of these thoughts there. You know, we want to get these points out to really get you thinking about them, right?
Right.
And so in that thought of thinking about them, we want to throw another question out there. So feel free to chat your answers to us. But we want to know, what are some of the challenges that you're facing, or what are some of the challenges you think you're going to face as it pertains to selling your business? I know obviously there's the whole COVID concern. There's the evaluation concern we saw at the earlier of this year, right? Like fitness companies, gyms, things like that. Well, like gyms got shut down, but anybody who sold any kind of physical exercise equipment, man, they had a stellar second quarter, right? Second and third quarter. So we've seen some challenges where these businesses think they're going to run like that for 2 years, and now they can continue to go at that valuation, but already sales are starting to decline, right? So that's just a simple example. So one of the things we have here are broker fees. Saying they're not reasonable. I know at a former employer I worked at, I think we did mergers and acquisitions somewhere around 4%. So it definitely can cut in there, right? What are your thoughts about broker fees, Tom?
Yeah, you should try to find 2 or 3 brokers and compete the firms against each other. You know, at the low end of the market, the smaller end of the market, you know, I think you're going to see a laddered type fee structure because they want to protect their downside. And you should be aware of this. You know, if you get a broker type firm come to you and say, hey, I think your business is worth $10 million, look at their fee structure and you'll be something like, okay, in the first million I get 10%, in the second million I get 8%, in the third million I get 7%, anything above 5 million I get 3%. So basically they're saying is, yeah, maybe we'll get to 10 million, but I'm going to get 350,000 if I can get you to 4 million. So that tells you how confident they are. Whereas some banks or advisors will say, look, I'll do it for 1.5%, 2%, but if I hit above a certain threshold, I want to get 5% of that amount. That tells you they're confident they can beat the sort of minimum target.
Yeah, and me personally, I love that kind of structuring, right? I like to find mutually beneficial relationships. So if they can help me sell it for more.
Yeah, you're aligned.
Yep, absolutely.
Definitely.
So question, if a business is forced to close, what would you recommend about how to sell assets for the highest price, or how to try and negotiate any kind of loans or debts?
Negotiate loans or debts to get out of them?
So in the situation when a business is forced to close.
You're in an adverse situation. First thing I do is I'd get a good tax and legal advisor. You know, if this is a bankruptcy situation, that's a different set of circumstances. If you just say, I'm just getting out, I'm done. You want to make sure that there's no liabilities associated with that business following you into the next stage of your life. So I don't spend a lot of time on businesses that are closing. We work more on growing and selling businesses, but I'd say protect your liabilities long term and make sure you have good tax and legal advice.
Okay. Have you found any strategies or worked through any situations in particular where a business was trending towards bankruptcies and you were able to help them avoid the bankruptcy?
Yeah, you can, there's some distressed sales situations, which you could say, all right, because, you have to keep in mind when a business is sold, it comes to, you determine what's the value, the enterprise value of that business. And then you subtract any debt and add back any cash, and that gets you to the equity value. In the situation you're talking about, the business might have no equity value. And so, like it's got so much debt that all the value of the business is used up by the debt. In those cases, or if it's close, you could say, look, with this business on a better platform, more growth, better distribution, it'll do better. And I'll take a payout on contingency basis if the business hits this kind of revenue level 3 years out or something like that. So you can create some upside. Hard to get paid if the business is under duress. It's hard to get paid much for it.
Okay. And that actually ties in well with another question that just came up. So we saw this in Vegas, right? I know you're over in Minneapolis, but what's your advice for selling an events company, considering how hard they've been hit by COVID, right? I talk to these businesses daily, weekly, and we've seen 80, 90, even 100% decline in revenues. So if you've got some value to your business, but obviously there's no revenue coming in the doors right now, what advice would you give to that business today?
I wish I had some good advice. We had a client that was selling his business, and you say event, they made the prizes that are giveaways in state and county fairs. And, you make the basket, you get the ping pong ball in the water, you get the prize. And, they were doing about $20 million a year of revenue, and they were in a sale process pre-COVID and thought they could squeeze a little more out of it. And last year, their revenue went to zero because there was not a single county fair or state fair anywhere in the country, I think. And so the guy just closed the doors. Unfortunate. COVID has been such a unique situation because some businesses like that, and sort of a barbell, you've had some that have been really impacted. How many restaurants have closed, right? Or hotels, the convention centers, they're all really anything travel related. I have a company I work with in Minneapolis. They own a bus line, a regional bus line. They were doing all they could just to tread water because nobody's riding on the bus, right? If you're involved in something that might be considered essential, you might get some state help. Like in their case, a couple of states they operate in and said, we really want you to maintain these routes in our states because you bring people from the rural areas to the main cities. We think that's important. So they were paying them a certain minimum compensation just to keep the buses running. So if you could find that kind of a relief, that's one way to do it. In other cases, some businesses have gone great. I know a company that makes masks, and they did it for like for industrial type, painting shops and sandblasting and so forth. But they just repurposed, and they've gone from sort of 8 million to 40 million in revenue. Now, how sustainable is that once we get enough vaccinations out there? We'll see, right? But some have been great winners. Yeah. Most businesses have been in the middle, immediate impact and gradual recovery.
Okay. Yeah. And so, obviously in the events industry, it is hard to give good advice, right? Because when revenues go to zero, they don't have a lot of leverage on that capacity. So if you are in a situation where you have to sell at zero revenue, I guess my thought on that is, maybe look at a liquidation of assets to start or something of that sort. Would that probably make sense, Tom? Because they don't have
that's an alternative, and you can go to the best way to do that is asset liquidation firms. On the sale I was working on at the end of last year, again, the buyer wanted to take most of the equipment and most of the inventory, but they weren't going to take everything. And they weren't necessarily going to take the office equipment because they're actually moving the business from Los Angeles to Michigan. So they hired a business liquidator, and they came in and basically they agreed, we'll sell everything or ship it out and dispose of it and clean the facility, and then it's ready to go over to somebody else. So there are firms that will do that kind of work.
Absolutely. So if I'm looking to sell my business in the next year, what steps would you recommend that I take now?
I always think, we had this in one of the earlier lists here, but, getting prepared. So are there any risks that you can remedy? Do you have a concentration risk? In case another situation I worked on, 100% of the sales went through 2 salesmen. Now, if I was a business owner getting ready for the sale, I would have put both of those guys on some sort of retention agreement, employment contracts, non-competes. But they weren't. So when the buyer came in, he said, look, these guys are critical to the business. So I might be paying you $5 million for your business. I'm going to redirect 500,000 of that to these 2 guys. So you just cost yourself $500,000. You might have been able to do it more effectively when those guys didn't have the leverage of a sale that was going through them, so to speak. So I think you want to have, for most buyers, you want 3 years of historical financials, and particularly the last 2 years monthlies, so they get an idea of the trend of the business. And then I would do a 3-year forecast yourself, because you have a best idea of the future of that business and the future cash flows. If you let the buyer make their own assessments, they won't be as accurate or as good as yours. And so you'll end up getting less. So it gives yourself a better starting point.
You know, I like that. I never thought of it before, but if I'm selling my business, I need to take the approach of would I buy my business, right? And do that
Right.
research. That's basically what you said, right? Create your business plan, things of that sort, right? And then the other thing I would add is with that research, reach out to experts, right? Individuals like myself, Tom, there's plenty of people, the Sbdc, SCORE, there's so many organizations that will give free advice and get you connected to professionals who will provide that expertise. So, you know, get connected with someone. Tom and I will make sure that everyone has our contact information as well. So if you have additional questions, we want you to be able to reach out to us. We provide completely free advice. You don't have to be saying, I can only call Tom if I want him to sell my business or help me buy one. We are here to help with that, right?
But Tom does
now,
do that as well. We do, you know, advise on the sale of businesses for sure. But I'm always happy to take a call or two and give you some perspectives that'll be helpful and guide you in your thought process.
Absolutely, absolutely. So one of the things that had also been asked on here was talk me through the nightmares of a transfer, right? Or basically I kind of take that as what's that step by step, like, okay, we've got a sale, we've got an agreement, we're ready to sign. Now, what do those next steps look like, right? So when we look about closing a business or the steps to closing a business, there's a few different things we need to go through, right? First one, pretty simple, follow the instructions on the founding documents, right? I can't stress it enough. And I tell this to business owners as they're creating a business, but that founding document is crucial. So make sure you're honoring that, right? When we look at selling the business assets, a couple different ways to do that. If we're having to close in a non-ideal situation, is that a liquidation process, a piece by piece, or is that a big lump sum, right? Then there's all those permits. So in Nevada, we use Silver Flume and they log you through and you get state registration, county registration, city, you know, you name it, right? So, and also depending on what type of business you're in, you may have additional permits, additional license, things of that sort, right? So it's really important. You've got to go through, you've got to cancel all of that. This next one obviously is you just say the word and, you know, the tax laws, and obviously there's a huge stress on that, but it is very crucial that you understand when this money is coming in and how it's coming in, and then grab a professional to talk through this case. I've had situations where we've done sales of business towards the end of a year where we are intentionally structuring that so that we can spread the allocation of money coming in over separate calendar years to help out the selling seller, right? And that also just goes back to talking with someone who is an expert in tax law, because there are so many loopholes in the tax code that I'm sure you can find a great way to fit your situation about bringing that money in. Something that a lot of people don't think about, though, is resolving any outstanding issues with their customers or suppliers. Now, believe it or not, when you switch the company over, those vendors may not be willing to just instantly jump onto those same terms with that new business. So it's really important that helping them understand that and looking at those relationships, right? But Tom, I would love some things from you. So do you have any stories about this?
Yeah, I would say, you know, this closing is different than a sale of a business. Because remember, once you go through a sale process, the buyer is doing very detailed diligence on your business. They're giving you a list of 10 pages of information request, and you will organize your information. And the buyer will use that as a roadmap for what they need to do at close or right after close. So all of your licenses, your permits, any ownership of assets, proof of ownership of assets, anything that's going to get transferred in name to their entity. They may, you know, in terms of customers, creditors, we would always try to structure a transaction so that we didn't have to go back to customers and repaper it, you know, because they're still working with the same people, and over time you could introduce new people. But if you have, let's say, a M&A advisory agreement and it says change of control, you have to get the, you know, the client to reapprove that. Now you're going back and asking a third party for basically, you know, approval of what you're doing between you, a seller and a buyer. So for the most part, you try to not involve customers, creditors, and suppliers in the papering over of the transaction, but sometimes you have to. So I think you'll have a good roadmap if you're going through a sale process between the buyer and seller on all this transitioning. We always used to, when I worked as a buyer, we use the diligence process as our roadmap and put together a schedule from closing onward of how we're going to integrate that business into our existing platform. So whether it's, you have a lot of things here, but it might be converting IT systems, right? And you might need different licenses for IT and so forth. So your different groups will be going through this, and you'll have IT diligence, you'll have customer diligence, you'll have supplier diligence, and you'll have legal and financial diligence, and it'll all get very organized. Keep in mind though, if you're selling it, you're running the business as your day job, and then going through the sale process is your second day job. It's very time consuming.
Absolutely, absolutely. Now, one of the things that was asked on here is expectations on time. So if you are looking to sell your business, and let's say the thought just popped in my mind today and I'm like, hey, I want to look to sell my business, what's a realistic time frame to complete that?
I'd probably make sure I spend a couple of months at least getting ready for it. Having my records in order, doing my, making sure my financials look good or appropriately, maybe have an accountant even take a look at them, see how a third party is going to look at your financials if your accountant doesn't do a review or compiled in a certain sense. Certainly most businesses don't have audits. So I did get myself ready, and maybe take 2-3 months to do that. And then the process itself probably is a 3 to 6 month process.
Okay, makes a lot of sense. Absolutely appreciate that, sir. So obviously we've talked a lot about selling a business, and one of the things that we've also want to talk a little bit about is when we're looking at planning any type of succession or retirement planning. Now, the one nice thing is I didn't see a ton of questions from anyone on the call at the top of the line. So we're going to spend a little bit less time here for 2 reasons. One, we did say that we wanted to try and end at 11:15 for you guys. So I want to be respectful of everybody's time. So if you have any questions as it relates to retirement planning, things like that, please feel free to start throwing those in the chat. Or if you have questions about other stuff as well, we want to make sure to be cognizant of that as well, because at the end of the day, we don't want any questions not answered. So if you have any additional questions that have come up that we haven't answered yet, shoot those in and we'll work them through. But the reason we talk about planning succession is so often people think about selling their business, and there are ways that you can strategically plan and prepare for that long before you're even thinking about being ready to sell, right? So when we talk about planning for a succession, we want to think about a question here, right? And the question that I would want to put out to all of you is, what is the most important reason for selecting a successor? Right now, rather than in the sake of time, I'm going to let you answer this one, Tom. So what do you think is the most important reason for selecting a successor?
Well, I think it's clear. If you're going to run your business as if it's for sale, it means you're going to minimize all the risks to your business. And if you, as the owner, are the primary value driver, you manage it, you have the client relationships and so forth, it's a huge risk. COVID brought this to, sharp focus for many business owners is, what happens if I get COVID and I'm out for a month or 2 months or 6 months? So you should have an idea of who would succeed you. And it might be 2 or 3 people. You might split the job. But beyond that, I think you might have 2 or 3 or 4 other key people. So I think it's very few companies do this, but it's a good discipline to incorporate as part of your annual employee review process to say, who would take your place, or what role would you take if I gave you additional responsibilities, and make sure you don't have a hole or a key person in any of these roles that you don't have a good plan to replace if something happened. It's just managing risks for the business.
I think that last sentence says it entirely, right? For me, when I think about identifying successors for a business, I try and identify where are the big risks and who is someone that can assist with that, or how can I help transfer the knowledge I have to that next level, right? Of driving them through and ensuring that the business is going to succeed, right? So when we look at the things to consider, my number one recommendation, if you're thinking about starting a successor, is start early. right? You've got a manager or an employee for your company right now that is your best advocate. They could be your best salesperson, or maybe they just really love your cause or purpose, right? Talk to them about thoughts of what it looks like to be involved, you know, start giving them additional tasks, activities, right? Things to demonstrate their abilities to make critical decisions as a business owner, right? So when we talk about training them, you know, identifying them is really as simple as just having that conversation, speak to it to find out their interest. It's so amazing, and there are so many businesses that have employees, and these small mom and pop ones in particular. I know my family had a restaurant growing up, and one of the things we found out by one of our servers is when we were getting ready to exit the business, we didn't realize how tied they were to our company, and they were ready. You know, when we even just mentioned it one day in passing, they're like, we want to buy, you will not talk to anyone until you speak to us, right? And I know as a business owner for my family, my parents, that was amazing, right? So just have those conversations, talk to them about it, right? When we talk about getting legal advice, there's a lot of different ways that you can plan for succession. So we're going to hit some quick highlights when we talk about that, because you've got to plan for the retirement, right? But you've also got to make sure, are you going to be giving benefits just to yourself or just to someone else? And the reason I mention that in succession planning right now is if you're growing a company and you do see a position where you want to sell in another 5 or maybe 10 years, there are many times that the retirement assets will play into a portion of that valuation or how the company is structured. Or more importantly, there are ways that you can sell out of your business by selling to your employees through an employee stock option, right? Or it's called an ESOP if anyone has heard of it, right? But it's a great way to transfer ownership to your employees. And what's really neat about that is when you transfer that ownership, you're not looking for, you know, one big person with a big paycheck. In essence, the business can almost finance itself by selling off to the employees, right? There's a lot of cool ways to do that. But when we look at the benefits you're offering employees or the employee benefits that are on the table, when you're looking at that, you can help to reduce your current tax income. And one more slide there, or 2 more, I think, actually. Sorry, Gina. Yep, right there, perfect. So when you're building out retirement plans, remember that any employer contributions to that are tax deductible, right? The assets grow tax-free, right? So a 401k, things of that sort. But there's also really cool benefits that can be made as a business owner. For example, if you are matching your employees on the 401k and you have any type of vesting period, when you lose an employee, the plan actually gets to decide what happens with that vesting, right? And there are ways that you can actually structure incentive for your employees to entice them to be a long-term employee. I don't know about many of you, right? But I know in some of the jobs I've had a vesting period where I get matching from day one, but only 20% of that money is actually mine every few years. So if I was a business owner and I'm looking to potentially sell my business in 4 or 5 years, I would like to start enticing my employees and leveraging them in to get their buy-in, right? And that's why we talk about retirement planning through the succession process, because it's such a great tool, right? So those are the benefits to the retirement plan. Obviously, your employees have a ton of benefits, right? They're reduced tax liability. You know, it's retirement for them. Those are going to be the great things that it gives them, but it's really just the buy-in, right? When we talk about benefits for employees, I mean, we need them, right? We know we need them personally, and we know they make us feel safe and secure. And so as a business owner, it's about the security that you're offering for your employees and how you want to make them feel comfortable with it, right? So if we look at the plans that you can offer for them, there's a few different types, right? So the common ones you've probably heard of are going to be what's called a SEP, a self-employed pension, a simple, or a 401k. Now, I'm not going to jump into all the specifics or differences between these, but I will tell you this. If you don't have a retirement plan for your employees and it's something you want to consider, do some research, because some of these require you to contribute on behalf of employees. Some of them don't require it, but then also others have limitations of how much you can put in yourself based on how much your employees are going to be putting in, right? So there are so many considerations when it comes to retirement plan that the number one thing is get a professional, right? You have to have securities licensing to even discuss those things with you. Secondly, learn about all of the different options available, because not every plan is right for every business. Just like selling in one avenue may be better for a restaurant versus a manufacturer, right? Similarly with your retirement plans, based on what your thought process is of how you're going to sell, who you potentially are identifying as your buyers, those could play into what type of retirement plan is going to be best suited for your business as it pertains to structuring the sale, right? And then the 3 key points that we want to consider are really just—
Before you leave that, Steve, before you leave that, I think one other aspect of this, and this is outside of my field, but also you should consider having the business buy an insurance policy for yourself, so that if something should happen, the proceeds of the policy can provide continuity in the business. You know, the business can then buy out your estate for your ownership, as opposed to, you know, so I would look at doing insurance planning as well, integrated with your business.
Okay. And could you elaborate a little bit more on that? Are you referring more to like a key man policy?
Yeah, like a key
or—
man policy. Yep, you could do that. That's one aspect. There's different insurance products where you can do sort of for 2 or 3 key executive owners, you could do a defined benefits type program. Now, that, again, that's beyond my expertise, but usually it's key man, but you couldn't do these type of defined benefits for a select number of executive / owner that, you know, is tax efficient. You can look at that as well, but using insurance products to protect the business through key man and then these type of retirement.
Absolutely. Yeah. So when it comes to retirement planning, you can either have defined benefits or defined contributions. So what everybody thinks of in the world today is defined contributions. That's your IRAs, your 401ks, where you determine how much you put in and they say how much they're going to match. When you have a closely held private business, particularly I've done this a lot with the doctors, professionals, things of that sort, you can structure a defined benefit plan where instead of saying this is how much we're going to contribute, you say this is how much I want to be paid at the end, right? This is my defined benefit, the benefit I want to receive. Those things have to be heavily funded, but when you have a small knit group, or you have like say a business that's owned by 5 people or 2 or 3 people and not a ton of employees, it's amazing how much money you can stock away in a defined benefit plan. So those 100%, you need a specialist. We pay actuaries to run timetables on those, to run the analysis for them. But the key man groups can be life insurance, disability, right? Because you got to think, not only does someone die, does someone become disabled, things of that sort, right? So absolutely, those are all great pieces on there. We have hit 3 minutes over, so in respect of everyone's time, Gina, if you would just jump us to the last slide, because we want to make sure that everybody has the Sbdc information, because that's how we had the opportunity to even speak with you guys. So if you have questions, if you have concerns, I love working with the Sbdc. Lisa is obviously the trainer over there, but they have many mentors that have been invaluable in helping my business owners, creating business plans, marketing strategies. What's really cool is you get connected with these people and they start connecting you to other people in their network. So some of the people from the Sbdc have been able to partner with other business owners that are now receiving free services because it's mutually beneficial, right? The reason I mention that is surround yourself with experts. If you don't have a banker, I would be happy to be your banker. You don't even have to bank with US Bank. If you just want someone to talk to, come talk to me, right? Get those, we'll help you to get those professionals you need, those tax advisors, things like that. But it all starts with a mentor at the Sbdc. You need to understand who you are, who your business is. So I'm going to turn it back over to you, Lisa. I just want to say thank you so much for giving us this opportunity. And then to anyone, if you had any missed questions, my contact information is there, as well as Tom's. You're going to get a follow-up email. We'd be happy to just continue conversations about this or anything else associated with your business. So thank you so much.
Yep. Thank you both. Thanks everyone for attending. Again, Stephen and Tom's information is in the chat if you need that. You'll also be receiving a couple of follow-up surveys, so if you could fill those out. Again, I will take a little bit of time to take this recording and cut out a few pieces, like the beginning when we're getting set up and a few personal information. So that will be out soon. Give me a week and I'll send that out as well. So thank you all for joining us. Have a great day. If you have any more questions, please reach out. And if you need a business advisor, head over to nevadasbdc.org and we can get you connected with someone. Have a
Okay,
good
thank
day.
you. Thanks, everybody.
Thanks so much.
Thank
Thanks,
you.
Tom. Thanks, Gina. Thanks, Lisa. Bye.
Bye.